All right, let's jump right in. Today, we're digging into a company called CNXN, ticker symbol CNXN. And believe me, it has a fascinating and in some ways a really unusual financial story. Let's see what the numbers have to say.
You know, when you open up a financial report, it can just look like this wall of numbers, right? It's intimidating. But here's the thing, hidden inside all that jargon is a pretty simple story. So today, we're going to find that core narrative and figure out what really makes this company tick.
So, here's the game plan. We're going to start at the basics. Is the company even stable? Then we'll check out its performance, try to figure out what it's worth, and see how it pays back its investors. By the end, you'll see how the whole picture comes together. Let's get to it.
Okay, first things first. We have to look at the foundation. I mean, before we even dream about growth or profits, we gotta know, is this company built on solid rock or, shifting sand?
And bam, here's your answer. It's one single, incredibly powerful number, 0. That's CNXN's long-term debt-to-equity ratio. To put it simply, they have no long-term debt. And that is just so rare.
Think about that for a second. Most companies, almost all companies, use debt to grow. It's totally normal business. But CNXN, they're playing a different game entirely. Having 0 long-term debt gives them this incredible financial armor. They don't have to worry about banks breathing down their neck, and they can weather pretty much any economic storm. It just screams conservative, careful management.
And that safety net, it doesn't just apply to the big picture. It's there day to day. See this thing called the current ratio? It's just a simple way to ask, can they pay their upcoming bills? And for every single dollar they owe in the short term, CNXN has almost $3 ready to go. That is a very comfortable cushion.
Okay, so the foundation is rock solid. We've established that. But a great foundation is kind of useless if you don't build something awesome on top of it, right? So the next question is obvious. How is the business actually doing? Let's pop the hood and look at the engine. All right, now this is where the plot thickens a little bit. If you just look at the last 3 years, you'll see that revenue has actually dipped a bit. But, and this is a big but, if you zoom out just a little to 5 years, you see revenues up, and even better, profits are growing way, way faster. So what does that tell us? It tells us they're getting smarter and more efficient at making money, even if sales have been a bit slow lately.
So what has all this meant for the people who actually own the stock? Well, the recent returns are pretty great, compounding at over 13% a year. But check this out, the 15-year number is even better. We're talking almost 16% a year, every year for a decade and a half. This isn't some flash in the pan. This company has been a quiet, powerful wealth-building machine for a long, long time.
And here's one of the big reasons why they've been so successful. This number, return on invested capital, or ROIC, it basically just measures how good a company is at turning $1 into more dollars. As a rule of thumb, anything over 10% is pretty solid. And CNXN, they're sitting at a very healthy 13.7%. That tells you management knows what they're doing with their capital. Okay, so let's recap. It's safe, it's profitable, it's been a great long-term performer. But that all leads to the million-dollar question, doesn't it? What's it actually worth? Are we looking at a bargain here, or is this thing priced to perfection? And, well, this is where the story gets really messy. Because depending on which crystal ball you use, you get 2 completely different answers. Look at this. One model, based on cash flow, says the stock is a steal. It should be worth over $100. But another model, based on earnings, says it's actually expensive right now. That is a massive difference. And it's the perfect reminder that valuation is definitely more of an art than a science. So, let's try to slice this another way. Forget the fancy models for a second. How does the stock's price today compare to its own recent history? Well, if you look at these 2 common metrics, price to earnings and price to sales, you can see it's trading just a tiny bit above its 3-year average. So by its own historical standards, it's not on the discount rack, but it's not ridiculously overpriced either.
All right, let's switch gears for a minute and talk about something that's actually a pretty new, and I think really significant, part of the CNXN story. And that's how they're giving cash directly back to their shareholders.
You have to see what happened here. For years, the company just didn't really focus on raising its dividend. But then, look at the last 3 years. It's like a switch flipped. All of a sudden, boom, we see this massive, aggressive push for dividend growth, averaging over 35% a year. They're now on a 3-year streak, and that's a huge signal that their whole philosophy on rewarding shareholders has changed.
So, let's put all these pieces together. We've looked at the foundation, the engine, the price tag, and the shareholder rewards. What's the final takeaway? What's the real story that all these numbers are telling us?
Okay, let's boil it all down. We've got a company with an absolute fortress of a balance sheet, no long-term debt, it's a proven wealth builder over the long haul, even with a recent sales slump. The valuation, that's kind of tricky, it's a bit of a toss-up. And finally, it's just recently decided to become a serious dividend growth machine.
And all of this really leads to one final big question. You know, we live in a market that's just obsessed with the next big thing, right? Explosive, high-risk growth. But CNXN, it represents something else entirely. It's about stability, financial discipline, and quiet, long-term compounding. So the question to leave you with is this. In the race for the next shiny object, are investors maybe overlooking the incredible power of just being stable and consistent? Something to think about.